Hello guys, welcome to another video. I'm Adi from Pixel Profits, and in this video I'm going to talk to you about the concept of premium and discount. This is also called dealing range by ICT, but it's a pretty simple concept in that in trading we want to buy when the price is low and we want to sell when the price is high. And I think everybody, even a complete beginner, would understand that that was the best way to do things. Now what premium and discount gives us is the ability to assess whether price is in a favourable place for us to be able to enter the market. And we do that traditionally by drawing a box around a range of price. But in this video I'm going to show you the traditional sort of way of doing it, but I'm also going to show you a couple of variations, one of which I haven't really seen shown in many places, almost none actually. But I think it's equally, if not more effective than the other methods. So stick around for that. Okay, so let's get into this. So we're starting off here today on the Canadian dollar chart. And why have I picked that? Because it doesn't matter. This could be any chart. If I didn't tell you what it was, you wouldn't even know. Okay, so ignore what chart it is. I just used this one because I saw a good example and I thought I'd do it. So here we can see the 200 moving average, and we can clearly see that price is in a downtrend. Now, following our market structure, we can also see these pullbacks, expansions, and so on. We're on the 4-hour chart here. All right, so how do we assess where price is and whether we want to be selling? Because obviously in a downtrend, we want to be looking for sells, right? So let's take a piece of price action here, for example. So I'm going to use a GAN box for this because I prefer the way the GAN box functions, because it has two anchor points that you can use to draw with. See the anchor points on every corner? It's much easier, I think, to draw accurately and quickly. Anyway, here is a move up that then gets the structure broken here. Okay, so we've got breaker structure there, then we get a pullback and another breaker structure and so on. So if we were looking at this pullback here and we wanted to say, okay, when we get the breaker structure, then I want to wait for a pullback. I'm going to buy the pullback in order to go down. I want to catch the top of the pullback, let's say. So here we have our box, and we have 0%, 50%, and 100%. Okay. The green area indicates that within this range of price, when we're in the green area, the price is at a discount, so it's cheap. And when we're in the red area, price is expensive. So obviously when we're going short, we want to try and buy at expensive prices and sell at cheaper prices. Okay. So here we can see a change in the state of delivery on the 4-hour, right? Now, if we wanted to buy then, we're waiting for the pullback. What we could say, and we could have this as one of our rules, is that we're going to draw the range and we're going to wait for the pullback to come into the premium prices before we're even going to think about selling. Okay, so in this scenario, we've got the downtrend, we have the move coming up, and we can see that these up close candles don't get closed below, nor do these, nor does this one, nor do these, okay, until here. This is where we get a change in the state of delivery. And where does that change in the state of delivery happen? It happens in the premium area of price. So if we were going to have this as one of our rules, that we only sell in premium, then this trade would be perfect, right? We've filled in this fair value gap. We've got a change in the state of delivery. It's happened in premium. We're in a clear downtrend from a market structure perspective and the 200 moving average. So with those things in mind, we could easily take a short here, right? And it looks something like this, wouldn't it? We enter when price breaks below here. We'd have a stop somewhere on the highs and we target, say, 3-1. Okay? So although, of course, if we wait for the premium prices, we may end up missing trades, this could keep you out of many potential losing trades. And it also adds just a structured framework to be able to assess when you're going to sell and not even consider selling unless price gets into this box. So it's a pretty simple concept, right? If it's in the red, then we're going to sell. If it's not, we're not going to bother. So if we got a mini pullback like this, we would say, no, I'm not interested. Okay. Because it hasn't gone into the premium price. It's still in discount. Now, another method we could use is to use a GAN box again. So here's a GAN box that I've drawn onto the chart, and this one has a few different levels. that we could assess. So rather than just having a 50% level, like we had in our previous example, so what if we said that we only consider premium to be when price gets above, the 0.618 level? And we can mark out various different levels. You can do whatever you want in here. You could do a DTFX style one where you have 30% like this, 50% and 70%. You could do whatever you want. As long as you stick to whatever rules you've set yourself, then it shouldn't matter, right? So what you could do is then say, okay, this is my discount level. If it's in here, that's not discount. Okay, so we could use a Fibonacci tool or Fibonacci levels, or whatever levels you consider that you see in your asset that you trade that are getting hit often. Use whatever it is that you think is your criteria, and you just stick to that, and you don't take any trades if it doesn't get to them. And this is what I think ICT calls OTE. And he basically has a fib and he draws it, and price gets to a certain point, and that's where you're looking for your optimal trade entry. It's all the same stuff. It's Fibonacci, it's Gann, it's all this other stuff, right? It's ICT, it's everybody else. Everyone's got their own version of this. It's been around a long time. No one in this lifetime created it. So, yeah. Anyway, so those are two methods you could use. A simple 50% or a Fibonacci / Gann box with whatever levels you want. You could use traditional fib or you can use your own. Now, here's the third option, and this is one I quite like. This is anchored VWAP. Now, anchored VWAP is actually a tool within TradingView. And what it does is it allows you to drop a VWAP onto any point you want on the chart. Now, traditional VWAP is volume weighted average price. And what it does is it basically creates some type of moving average, but it puts emphasis on the volume traded at different levels. Now, VWAP is super important. Why? Well, if we take a look at this testimony here from Kenneth Griffin, who is the founder, I believe, of Citadel Finance, which is one of the biggest funds in the world and one of the biggest market makers, which, let's face it, you're trading against market makers, right? So if he is saying that the VWAP is important, then you should take note. And I'm going to post up a screenshot on the screen now of some of his testimony and some of the quotes from it, so you guys can take a look, and I'll put them up in text or something on the screen. But he's basically saying that the VWAP is used to execute most trades, and that they scale into them over days, months, weeks, whatever, and that algorithmic trades are often based on VWAP. So if they're using it, why aren't you? So what we can do, and this is my personal favorite way of assessing this, is we can drop an anchored VWAP on our range of price, and we can look at the levels that get touched. So here's the tool. You can find the anchored VWAP under forecasting, and then you've got anchored VWAP here, okay, volume based. All right, so I've got it in my hotbar here, and what I'm going to do is I'm going to drop it on the same point where we started this range of price, okay? Now, you might think, oh, what is this? Bear with me, because this is going to be good. If we double click on the VWAP, what you'll normally only see is this blue line, but if we double click on it, we can expand these lines, and let me show you what they are. So when you go into the options, you've got these band multipliers, and you want to select standard deviation. You want to select all of them, 1, 2, and 3 standard deviations you want to input here. And then you want to go to source, and you want open, high, low, close divided by 4. Now that doesn't matter too much, but I think that's the optimal setting, but you can play around with others if you wish. It will normally default, I believe, to close. So we've got those options set, and then we go to style, and you can style this however you want. I don't have the background on because it just spams some background on there that doesn't look good. But you just change the colors to whatever you want for the upper and lower bands of the different standard deviations. And that is all you need. And you hit OK. Now what that gives us is a VWAP that's anchored to this candle, the first candle of the range, okay, the swing low, if you like. And then what it does is it puts a VWAP on the chart, but it also puts standard deviations of that VWAP. So it's a little bit like something like a Bollinger Band. The power in this is that these levels are dynamic, so they change. So they're not fixed like this 50% level. They change over time based on the price movements. So you can use them multiple times to assess whether you're in premium or discount. Now, obviously, you can delete these and add new ones, and you can have them overlapping and all kinds of stuff for extra confidence, but don't worry about that now. We'll just focus on this one. So what have we got? So price obviously doesn't do much down here, and you can see the VWAP's very tight, but it starts to expand. Now, when price gets to these outer levels, especially the second and third standard deviation, this is when we start wanting to pay attention. Because what we could see here, right, is if we were doing this range of price in our previous way with the normal premium and discount box there, we'd have to wait until the price goes all the way up, makes a high, and then breaks the structure. Now we can draw our zone, right? Our premium and discount zone. So we'd have to wait till here to be able to draw it. But with the VWAP, as soon as you start seeing price, climbing, you can whack it on and you can see that it starts to track the price. Now what that means is you can have the VWAP on there much earlier. So you could potentially take trades much earlier, because you're seeing that when the price goes above the blue line, then we're basically in premium prices. And when it gets to the second or third standard deviation, we're really in premium. Because this third standard deviation rarely gets touched, especially when price has had a chance to, there's a little bit of data that's been assessed. And we can see that they give really strong reaction points. Look, when the price came down here and hit this third standard deviation, got an immediate rejection off of it, and then we climbed up for the pullback. So when price got overextended from the average blue line, okay, the average price, we got an immediate rejection and a pullback into the average price. And when we got to the average price, we then go into the premium prices, okay, compared to the blue line, the VWAP. And then we start to fall off again. And every time, look, we get to the premium, we start to get rejection. Now, the premium 50% level of the box that we drew has got we are in premium technically there. We are not really in premium here because we didn't reach that 50, because that 50 is now set. It's never going to move. Whereas the VWAP is adjusting to the price movements. We can see that we are in premium here and we are in premium here, right? According to the VWAP, but not according to our other tool. So our other tool is failing to keep up with what's actually really happening in price. And that is why, one of the reasons why, this VWAP standard deviation system is so good for assessing these kind of moves. Now, we can also use the blue line as support or resistance, or any of these lines. You can see how it hits the first standard deviation here and gets rejected many times. And obviously, when we're in a downtrend, we're not necessarily looking for these up moves, although we are expecting a pullback after a break of structure, right? So we could, when we see this candle, we could start looking for some sort of up move on a smaller time frame. But really, we're looking for down moves. And you see the amount of times that we get these overextensions, if you like, or these rejections from these levels. And it happens all over the place. And as you can see, once it breaks above and then it starts to climb above, then eventually we get our uptrend. Okay, so what we'd want to do, of course, is we don't want to leave these on necessarily forever, because they're going to expand out. And I mean, they're still good to use, but what we'd want to do, of course, is reassess and start with more anchored points and delete this old one and start new anchored points for the uptrend. Okay, we could do that if you want, just to show you. Let's delete that old one now. So here again, we're climbing above, and look, we're breaking above the VWAP, and now we're in an uptrend, a bit like the moving average, right? And you can see all these, look, support from the standard deviation. We get to the overextended, we start to come back down a little bit, we get supported again, we get to the standard deviation, we get a drop, we get another rejection. We'll see what happens later, because that's today's price. But you can drop these wherever you want, and you can use them for as long as you want, and you can do multiple ones if you don't get too confused by it, and you can drop them all over the place and see, look at these rejections here. Look at that rejection. Look at this one bouncing off the VWAP. Look at this rejection. Look at these bouncing here, and another rejection, and a rejection off that VWAP. Come back down. And now we're sort of ranging in an uptrend. But you can see how using these, you get a much more dynamic view of the price, and you get much more sort of useful levels to base your stuff on. So I think anchored VWAP is super helpful, and we can do one from up here. Look, let's try one from up in this swing high. Look at the way it shows you the sort of downtrend, and the way that, look, the rejection from the VWAP here, for example. There's a lot of stuff you can do here to say, okay, you know, where are we in price and whether we're in premium and discount. But really, to use it on a range, you want to assess each range as it occurs. So here's one, for example. And as you can see, once we get up, we're overextended, we drop, we're overextended again, we come back up, fail to make a new high. This is our pullback, right? And down we go. So it's so much more dynamic and so much more indicative of what price is actually doing. And so I haven't seen many people talk about this, but it's a great way to assess where price is at, where price is going. And here again, you know, bounce off the VWAP and go up. Gets overextended. Start to look for a change in the state of delivery maybe. Here we get one, and then price starts to drop down back towards, guess where? The VWAP, and then we get another rejection off of it. Look, break of structure, change in state of delivery, right? Yeah. Change the state of delivery, hit it again, up we go again, okay, on the VWAP. So you can use these to assess dynamically in real time, and it will change for you. This doesn't change. This is static. So yes, you can draw a new one on each range of price. And there's nothing wrong with these versions at all. I just wanted you to consider that I haven't seen many people talking about the anchored VWAP and how you can use it for premium and discount. It's actually super effective and super useful. And it also effectively gives you a moving average to track at the same time. And you can use it in conjunction with other things like other moving averages. So go away and have a look at this, because again, I think that it's super useful. I don't know what happened there. Wait. Oh, there we go. Bit of a delay. It's super useful for tracking this kind of premium and discount. It also gives you these dynamic support and resistance levels that are very effective. And as I say, these overextended levels are super good because they often get reactions from, especially if you're taking the trade in the right direction. So if we're going short here, we're looking for reactions from obviously the upper bands, and then we want change in state of delivery or whatever to confirm. It also gets you in, as I said earlier, to assessing your position compared to the VWAP, because like I said, when we break here, we have to wait for this candle to close before we can draw our box. Whereas the anchored VWAP, we could say, well, that looks like a swing low. It's broken structure here, so that's probably the pullback. So we'll just start it here and see where it goes, and it's going to track it for you. You don't have to do anything more. Now, one other place I wanted to show you is how effective it is in a range. So let me find an example of that, and I'll be right back. Okay, so here we can see that price is ranging sideways. We can see the moving average, the black line, is getting broken above, broken below, broken above, broken below. So we're clearly in a range. If we assess this with our change in the state of delivery method of tracking a range, we'd probably see the same. But this video is about the premium discount, right? So if you're trying to draw premium and discount on here with a box, where are you going to draw it? Whereas if you wait for this swing low here, and just check I've got that right, wait for this swing low, which is this candle here, and that's the thing, you can drag this around and drop it, re-drop it, you don't have to redraw it. Now, look at the way price has reacted in this range. Now, what do we say about trading ranges, right? We wanted to make sure that we trade sort of the tops of a range downwards and the bottom of the range upwards, right? Now, what this is giving us, this VWAP, is a representation of where that actual range is, okay? And if we said we're only going to trade from the second standard deviations or the third, look what happens. We hit there, we go down. We hit there, we go down. We hit the bottom, we go up. We hit here, we go down. We don't get to the bottom one, so we ignore that. We get up here, even to the third one, and that's super overextended when it gets to the third one, and then a big move down. We hit the other one, we wait for a change in state delivery, here we go, that's our trade, boom, goes up, and so on. Here, look, we've gone above, change in state delivery, goes down. Look how good it is for tracking these ranges in conjunction with things like changing the state of delivery and other stuff. Fantastic. So you can use this to assess the premium and discount of a range. And it gives you a super mechanical, super simple way to assess where you are in the price. And it's updating dynamically as price moves. Fantastic tool. I would recommend that you guys give this a go for your tracking of premium and discount. And you can use it in conjunction with the other methods as well. You can do all three at the same time if you want. But this one, in my opinion, is super useful. And as price ranges the majority of the time, effectively, this is a great tool for getting in and out of trades and giving you those exact levels where you want to do so. All right, guys, that's about it for this video. If you like the video, subscribe, hit the like, leave me a comment. Let me know how you use these tools and what you think about them. And I hope to see you in the next video, guys. Take care. Thanks for watching.